Welcome back to the Deep Dive. Today we are tackling an intense one. We're doing a deep dive into the Q3 2025 results for Universal Display Corporation, or UDC.
And this was not just another quarterly report. This was a really sharp, clear inflection point for the company.
Right, because they'd had, what, 3 straight quarters of beats. Expectations were sky high heading into this.
Exactly. And then this report drops after hours, and you just saw this significant repositioning from institutions. The stock got hit, and hit hard.
So our mission today is to break all that down. We're going to dissect that surprising financial miss, dig into management's story, this idea of a timing shift, and really try to understand why the market reacted so negatively.
Yeah, because the market reaction itself tells a huge story here. The stock dropped nearly 15% over 2 days.
Wow.
And the options market was only pricing in maybe a 10% move. So that tells you investors were genuinely shocked by what they heard.
Okay, so let's start right there. Lay out the hard numbers for us. What was the headline miss that sparked all this?
The financials were, frankly, pretty jarring. On the bottom line, JAP EPS came in at just 92 cents a share.
92 cents. And the consensus was looking for about $1.19.
It's $1.19, yeah. So that's a 23% miss right there, out of the gate. And revenue was just as disappointing. It came in at $139.6 million.
And the street was expecting somewhere in the, what, 165, 166 million range?
Exactly. So you're looking at a 15% revenue miss. And maybe more importantly, that's a drop of almost 14% compared to the same quarter last year.
Okay, so where in the business did that weakness come from? Was it their core materials business?
Well, that's the interesting part. Their material sales, the red and green emitters they sell, that was basically flat year over year, around 82, 83 million.
So not great, but not the source of a 15% miss.
No. The real pressure point, the big surprise, came from the royalty and license fees. That segment dropped substantially.
And that was because of that one-time adjustment I read about.
That was a huge piece of it, yes.
Yeah.
They had to take a $9.5 million out-of-period downward adjustment to their royalty revenues.
Which basically means it's an accounting true-up from a prior period, not necessarily a reflection of this quarter's business.
Correct. But, when you factor in a hit that big, even if it's non-operational, it still muddies the waters and definitely contributed to the size of the miss.
And of course, management really leaned on that adjustment and this idea of inventory shifts to build their defense. How did they explain the weakness?
Their argument was that this was all about timing. That's the word they kept using.
Okay.
The story is that their customers got worried of the macroeconomy and pulled a bunch of orders forward into the first half of the year, which left Q3 in like an inventory air pocket. They insisted it was not a sign of slowing OLED demand.
Right. So that's the defense. But here is the part that just doesn't quite add up for me, and I think it's what spooked the market. If this was all just a temporary timing issue, a one-off accounting thing, why did they cut their full-year guidance for 2025?
That is the $170 million question, isn't it? Despite saying it was a temporary blip, they trimmed the full-year outlook down to the low end of their previous range.
Which sends a very different message.
It's a total contradiction. To analysts, that signals that management might not be so confident themselves, that maybe there is some underlying weakness they're seeing.
And what that guidance cut means for the fourth quarter is, well, it's a huge hill to climb.
It's a Herculean task. To even hit the low end of that new range, UDC has to deliver an all-time record Q4.
A record quarter, coming off a massive miss.
Yeah. We're talking revenue a little bit above their previous high of about $172 million. Now, they said they're confident based on customer forecasts, but you can see why the market is, extremely skeptical.
Okay, but before we look too far ahead, let's touch on the margins. Because even with the ugly top-line numbers, the core business model looked pretty solid.
It really did. The margin profile is still incredibly impressive. They actually reaffirmed their full-year guidance for gross margin in the 76 to 77% range.
Which is fantastic.
An operating margin between 35 and 40%. It just shows you how robust that IP-heavy capital-light model is.
And they've got the balance sheet to back it up, right? A ton of cash on hand.
Absolutely. They've got about $1 billion in cash and investment. So that gives them tremendous flexibility, and it supports their dividend, which they just declared again at 45 cents a share.
Okay, let's pivot a little to the bigger picture here. Because on the same day they dropped these disappointing numbers, they also announced a really significant strategic move.
Yeah, this was a very smart, proactive move. They announced they're buying over 300 OLED patents from Merck KGaA for $50 million.
So they're reinforcing that IP mode.
They are cementing it. This deal extends their coverage, especially on some advanced device structures. It just makes their position as the industry's IP toll collector even stronger. They get paid no matter who's winning the manufacturing race.
And that move really supports their whole multi-year growth story, which is all about OLED breaking into new markets.
Exactly. They kept pointing to IT displays and automotive as the huge long-term drivers. I mean, the numbers they threw out for IT laptops, tablets, monitors were pretty staggering.
I saw that, something like a 170% increase in OLED units just between 2024 and 2028.
That's the projection, a massive expansion.
But for that to happen, you need the manufacturing capacity. Which brings us to these new Gen 8.6 fabs. Why are they so important?
So the Gen 8.6 fabs are critical because they use much, much larger sheets of glass.
Right.
And that makes it way more cost-effective to produce those medium-sized panels for laptops and monitors. And we're seeing huge players, Samsung, BOE, and China, investing billions to build these out, with production expected to ramp up in 2026.
So that signals a multi-year CapEx cycle that UDC should directly benefit from.
It's a direct tailwind for their royalty and material sales down the line.
Okay, that all sounds great, but it feels like there's one piece of the puzzle still missing. The phosphorescent blue emitter. What was the update on that?
The Holy Grail. They confirmed, continued progress. They reiterated it's going to command a premium price because of the efficiency gains. The problem, as always, is the timeline.
Still frustratingly vague.
Completely vague. They declined, again, to give a hard commercialization date. And that ambiguity, especially after a quarter like this, it just feeds the skepticism.
So the market has shifted from, we'll pay up for the future promise of blue, to show us the money now.
That's it exactly. The valuation has moved from priced for perfection to prove it to me. Prove you can hit Q4 and prove you can finally deliver on blue.
Which creates a really interesting setup. So let's move into a quick volatility forecast. And of course, we have to remind everyone this is purely for educational purposes.
Emphatically not financial advice. Please do your own research, your own due diligence.
Okay, with that said, the stock has been hammered. It's sitting at this prove-it valuation, but that huge 2026 growth story, the one tied to the new fabs, is still there.
It is. The setup is fascinating because the company is now, I think, highly leveraged to some very binary near-term events.
Meaning what, specifically?
It all comes down to hitting that record Q4 number. That's the first hurdle. And the second is getting some concrete good news, whether it's a favorable renewal with LG Display or finally a real timeline for the blue emitter.
And we already know the stock can move violently on surprises.
Way more than expected. So the outrageous but plausible trade idea here would be something that plays on that potential for a huge move in either direction.
Okay.
We're talking about a long straddle targeting earnings late in Q1 or maybe Q2 of 2026. So you're buying both an out-of-the-money call and an out-of-the-money put.
So you're not betting on a direction, you're just betting on a big move.
You're betting on volatility. Because think about the two scenarios. If they miss Q4, if they can't hit that 172 million number, the story of durable weakness is confirmed. The stock probably collapses again.
Right.
But on the other hand, if they do hit that record Q4 and maybe they pair it with good news on LG or blue, you could see a massive relief rally. The straddle profits from either of those big swings.
Okay, that makes sense. So let's bring it all together for a final summary. The core conflict is now crystal clear.
It is. You have this really significant Q3 miss driven by that royalty adjustment and, the inventory story.
Set against this unwavering long-term thesis from management.
A thesis that says the IP moat is stronger than ever with the Merck deal, and that the IT and auto markets are about to explode for OLED, powered by all this new fab capacity coming online in 2026.
But the market, with that 15% haircut, is saying, we don't care about 2026 right now. We care about the next 3 months.
The focus is entirely on that monumental Q4 hurdle, which leaves us with the final provocative thought for you to think about. If UDC fails to deliver that record Q4, the whole investment community faces a really serious question. Are we just watching a normal cyclical inventory swing for a company that is, at its core, a rock-solid IP toll collector?
Or Is this miss, followed by another miss, a signal of something more permanent, a real deceleration in their growth that fundamentally changes what this premium materials business is all about?
That's the dilemma, and we won't get the answer until those Q4 numbers come out.
A huge cliffhanger to end on. Thank you for joining us for this deep dive on Universal Display.
Our pleasure. And we just urge you to keep applying that critical thinking, especially when you see high volatility events like this one. We'll catch you on the next deep dive.